Hello, everybody. Welcome to this webinar on emerging markets. My name is Jean-Marc Routier. I work at BlackRock for the Global Emerging Markets Equities team. And I'm here today to discuss virtually on our outlook and views on emerging market equities. I work in an incredible team of about 40 people that invest in emerging market equities. What that means is that we pick companies that are listed or have operations in emerging markets, and we find attractive valuations, attractive investment opportunities, and we compose a portfolio of stocks to have a coherent and diversified portfolio. Now, the interesting thing about this asset class is that it is complex. You know, it trades 20 hours a day, trades about 6 days a week, courtesy of the Middle East, of course. And it's very diverse in its composition, in the way it trades. And that brings a lot of volatility and a lot of dispersion. So we have about 5,000 stock universe. We end up covering about 1,500. And we end up composing portfolios of about 50 to 80 names. And again, what we really enjoy with this asset class is there's many drivers. You have companies that are exporters, some that are importers. You have China, which is so important on its own that it drives a lot of the region. And we have a lot of ability to shift our allocation for different countries and different companies on where we see the most opportunities. Well, in 2020, we had some very interesting market movements. I need to tell you how incredible that year was for humanity and for health and COVID related. But of course, markets have reacted in a very interesting way. We started the year very positive, and markets were going up strongly. But then the COVID cases were clearly a very big issue for a lot of economies that started to go into lockdown, and that created a very short but quite big panic on market with a very large sell-off. And then from March, April, something extraordinary happened is that despite the COVID lockdown continuing, and despite the spread of the virus continuing in the world, markets have continued to perform very strongly. And we ended up with emerging markets returning double-digit returns, 18% to be precise, and outperforming their developed market counterparts. This is because of a few reasons. The first one is EM was an announced catastrophe in terms of health and COVID, and that just did not materialize. And the interesting stat is you look at fatalities, and EM is 4 times less impacted than developed economies. We don't really know why. Could be climate, could be immune systems, could be younger demographics. But the facts are that EM has actually done much better out of this human crisis than developed parts. And then because they have not had to burden themselves with fiscal stimulus that we've seen in the West, things have been a lot healthier in terms of an economic point of view for emerging markets. And that is started to get reflected in equity markets. So whilst the first half of the year of 2020 was quite bad for equity markets in EM, the second half was a lot stronger and boosted by the hope of vaccines that are coming through. You have seen a very, very strong finish. That means across the year, EM has been a very strong performer again. That's been great for beta, but it's been great for alpha as well, because having this dislocation and this big correction has created, again, a lot of opportunities for active investors like ours. Well, our outlook for 2021 on emerging market equities is quite positive. There's a few reasons for that. Liquidity is ample, number one. And what that means is there's a lot of capital looking for a place to fluctuate. And emerging markets is one of these markets that does provide growth and yield in the world that's a bit short of both. And you can see many stocks are going up slightly randomly in the world. And we think that capital will continue to find its way through emerging market equities. And we have found flows indeed picking up very strongly since after summer of 2020. And that has continued, and we think will continue because this liquidity is very strong. Secondly, the vaccines sort of rolling out is announcing a sense of normalization for the world. And this is very good for emerging markets because they're benefiting a lot from global trade and from general activity picking up. And we think that will sort of show into the markets eventually. Thirdly, through the crisis, EM economies have not really extended themselves too much in terms of fiscal support. And that means they're in a very healthy condition. At the time, I'm talking economically and fiscally and budget-wise, at the time, currencies of markets have corrected. And therefore, the starting point is very positive in terms of valuations, in terms of ownership. And that is why overall, we have a very positive view on emerging markets for 2021. However, here's the caveat. Things will not be as maybe straightforward as the rebound of 2020, which really favored one type of stocks. And in particular, China has been such a strong performer in 2020. So far, it's extended in 2021, but with renewed tension in the US, with the central bank tightening, things might not be as smooth and as linear as it has been for China in 2020. So like every time, things never really repeat themselves perfectly. And we think whilst opportunities will abound and whilst the liquidity will help markets to perform on a beta perspective, we think you need to be a lot more selective and you need to really project yourself into what's happening. Normalization, what does it mean? Which country have a good immunization system? It's very unequal in EM right now. And therefore, we are very cautious on what we own, and we are cautious on the country we want to have exposures to. So there's a few things we're very focused on right now, and I think there are mainly three key points. The first one is that the recovery that we've seen in emerging markets has been really led by China, and for several reasons. The benefits of having such a tightly controlled economy is that the authorities are really able to put a lot of stimulus into that economy, and they have done that spectacularly in 2020, which meant it has created a proper V-shaped recovery for China. Now, the key question is, can that spread and can that be replicated to other parts of EM? And the answer is tied to the second point. And what's interesting is not only the new variant, but also the vaccine rollout is creating inequalities through EM. Whilst the first wave was fairly positive across EM, in the sense that either you picked a very strong control, like you've done in North Asia, or you have gone for herd immunity effectively, like you've done in more South Asia and places like Brazil or South Africa. The new strains that we're seeing on the COVID at the moment and the vaccine rollout impacts countries differently this time. If you're in a place like India, for example, where you produce 60% of the world's vaccine, you're in a good place because India has secured enough for vaccination. If you're in a place like Brazil, interestingly, you're also in a good place because not known to many people, Brazil has been leading in terms of sort of conducting the first phase trials for all the laboratories. So they've managed to also secure a lot of vaccines for themselves. If you happen to be in the Philippines or South Africa, it's a very different story. Either through lack of organization or not having the health systems that the other EMs have been able to build, either in India or in Brazil, you're in a very different place and you don't have the same ability to conduct your rollout. So that's why, again, we have to be very specific. And the third point that we're also looking at is the geopolitical evolution. And of course, there's a new man in Washington, and the key question is, what is he going to do to places like Russia, to places like China? And interestingly, our view right now is that things don't change dramatically in regards to those two countries specifically, but also wider on EM. We think the Biden administration will want to retie the connection with the diplomatic world and the other allies that they have in the West to engage with places around the world. And we think that will take a bit of time, but we also are fairly convinced that the China-US relationship is not going to improve overnight. In fact, it will enter a new phase where tensions sort of move from trade towards more human rights, for example, and that US will engage with places like China and Russia through allied and sort of coordinated efforts through other places. So that brings mixed feelings in the sense that in the short term, things don't really change. You have a maintenance of a statu quo, but in the longer term, we think things do evolve, and it's going to create risks, but also opportunities. And that's one clear thing that we're watching. Well, our view on oil is actually positive for two reasons. First, demand will normalize. I know it's hard to believe, but we will travel again, we will use our cars again more, and we will go on a holiday again. We're positive on that. We're human beings. We need to do this, and we will have a sense of normalization once the immunization rollout happens. So demand normalization is a key factor. The second interesting point is that oil has not had much capital going into it in recent years for a few reasons. The first one is the environmental pressure that we are seeing. Capital is hard to get if you're an oil company. It's much easier to get if you're a sustainable or very growthy technology company. So there hasn't been a massive amount of supply being built in the last few years. And when you have a dynamic of demand normalization paired with supply constraint, you can work out very easily that price pressure is on the upside. And you can look at the oil price today, and it's already factoring a lot of that. We think it can squeeze even a bit higher. However, it's hard to play because a lot of the oil stocks are penalized by the sustainability trends that are happening in the markets right now. And despite the oil price moving up, the oil companies are not benefiting as much as before on that normally one-to-one relationship. So a place like Russia is actually a very good place to get oil exposure, or in fact, the Middle East, where you don't have to own direct oil companies. These economies are so impacted by oil. You can own financials or consumer-related names, and you get an effective secondary exposure to oil. So positive on oil, not very positive on all companies, but positive on companies that benefit from stronger oil price, which are effectively Russia and the Middle East. Okay, so here's the interesting question of the webinar. What is our view on airlines and travel? Well, this is the positive news. We think, like what we're seeing in the oil price, given the demand destruction that has been massive, and I don't need to tell you this, it's been dramatic. If you're in the airline industry, in the hotel industry, in the leisure industry, it's been terrible, and it's not over. But what is happening right now is a lot of the independent, a lot of the side players are disappearing. And that is valid for those three sectors. That means supply, again, is shrinking. That means when we're going to normalize, the demand is going to be so big and it's going to be met by very little offer because there's going to be a lot of casualties of, in airlines, in hotels. And that means from an investment point of view, we get really excited with the companies that can withstand this really intense time of pressure, and that we'll be able to see the next cycle. And we are invested in airlines, in hotels, in restaurants. In fact, we keep increasing our exposure as we go, and we keep finding the best winners, the people with the balance sheet, with the backbone to withstand that incredible shock that we're seeing. But we are very positive. So I know it's tough. We all here's doing this webinar from my spare bedroom. It's difficult. It's even tough for those in those industries, and I know you're part of that. So, but here's a positive note to finish this webinar on. We think this normalizes. We think we'll travel, we'll go on a holiday, we'll go on planes, and we're very much looking forward to do that very soon. Okay, well, that's all we have time for. Thank you all for your time to listening to this webinar, and wishing you all good health. And yes, you can share enthusiasm for emerging markets. We are looking forward to engaging with you on these markets and on our outlook for 2021 and beyond. Thank you very much again, and have a great rest of your day.